Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different aspect from the financial landscape and attempt to draw conclusions based upon the teachings of Benjamin Graham, the tutor and mentor to Warren Buffett, no less. In this edition, we should be looking at the interesting career of the British value investor Neil Woodford. We'll consider along the way his rise and fall from being arguably the UK's most celebrated and successful investor to becoming something of a disgraced figure after the collapse of his fund, Woodford Investment Management, in 2019. We'll consider his investment style, how he managed to durably outperform the market for over 2 decades, and what went so horribly wrong at the fund bearing his own name. So without further ado, let's dive right on in. As ever, sit back, buckle up, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. Those listening outside of the United Kingdom may not necessarily be aware of the British investor Neil Woodford. I'm not precisely sure how far and wide details of his exploits have travelled, but as far as I can tell, he does not have the same high profile as some of the modern era value investment greats like Seth Klarman and Bill Ackman, and I feel this may do him something of a disservice. However, most investors in the UK will surely be well aware of the man who, despite his most recent travails, surely deserves to go down as one of the all-time great value investors. Woodford's reputation was built as a star fund manager at the investment firm Invesco, managing its perpetual high-income fund over a 26-year period. Investors who had been quick to spot Woodford's potential at Invesco and stuck with him throughout his tenure with that fund would have been treated to gains of around 2,500%, according to some estimates, delivering an annual return of over 20%. This almost triples the sector average performance, whilst outperforming the FTSE All-Share Index more than 6 times over. A £10,000 sum invested in his first funds would have seen that pile grow to a whopping £250,000 26 years later. These are clearly Buffett-bothering returns, and in the UK at least, he was perhaps one of a rare breed of superstar managers who most people with any involvement in the stock market would have actually heard of. Woodford's style was very much rooted in the value approach. And at the heart of this was his belief that by taking a stock position in a business, the holder also becomes a de facto owner of that business. Tied up with this was his long-term outlook. Like all great investors, he viewed the ideal holding period in a business to be, wherever possible, forever. This resulted in him, on average, holding stock in a business for about 15 years. Woodford also proved to be reliably good at another trait vital to the success of any value investment practitioner. He was adept at spotting bubble conditions and other situations that just didn't smell right. This allowed him to avoid the booming internet technology sector in the late 1990s, and thus avoiding that crash, as well as the worst of the fallout from the financial crash in 2008. He paid heed to one of the most important principles in value investment. That is, first and foremost, never to lose money. Woodford was generally attracted during his time at Invesco to businesses that reliably paid out high rates of sustainable dividends. The sustainable bit here is the important word. He sought out businesses that reliably generated sufficient profits to pay out a high yield of dividend as compared to its share price. Here he would look to the accounts to ensure that the rates of dividend paid out were long-standing and durable. In order to ensure that the high rates of dividend would continue long into the future, he would look for businesses that had a strong qualitative showing. In this respect, he could be considered more of a Buffett-Munger-style value investor than the cigar-butt-seeking father of the craft, Benjamin Graham. As you'd expect given his decades of success and their ever-expanding pocketbooks, Invesco investors afforded him a godlike status. Woodford finally left Invesco in 2014 with one of the all-time great investment records, up there surely with Buffett and all. Subsequent to leaving Invesco, Woodford decided to branch out with his own investment company and went on to launch funds including his flagship one, the Woodford Equity Income Fund. His flawless record up to this point and his superstar status meant he was not short of those more than willing to let him invest their money for them. And at its peak, the fund had around £10 billion under its management. So where did it all go wrong? How did the man rightly vaunted for his flawless record over a quarter of a century end up becoming the sultana in the salad as far as the wider investment community was concerned? The fund initially had several decent years of performance, but in 2019 the fund began to perform poorly. And the investors in the fund did what investors have a propensity to do when they suddenly see their net worths plummeting at an increasing rate of knots. They panicked and wanted their money back. This panic quickly spread, causing a run on the fund, and as more and more investors began withdrawing their money, the fund began to struggle to meet these redemption requests. Once its liquidity had dried up and its ability to pay out had been exhausted, the fund was finally suspended and eventually closed down. It is estimated that around 300,000 people lost money in the debacle, although it must be said some money was later recovered as assets were sold off. So what went wrong with the fund? The problem, in my view, can be boiled down to two main issues: a lack of diversification across businesses and industries, and poor liquidity. It must be noted that both of these factors are unlikely to be an issue to any individual investor who controls their own portfolio and is confident in their own abilities, as well as understanding the vicissitudes of the market. The problem was, in my opinion, the fund was being run like a private portfolio. This, in theory, should have put it in good stead to outperform the market over the long term. For a person can only have so many brilliant ideas, and over-diversification across multiple businesses and industries will only ever dilute the great results of these best ideas. This way of doing things is all very well and good if it is your own money you're investing and have control over redemptions. But this money was not his own, and he had no such thing. The value investor should understand very well that the downside to the concentrated portfolio required to gain the best possible performance is that any temporary poor performance by just one or two businesses can have an outsized detrimental effect on the portfolio as a whole. The value investor, well aware of how Mr. Market operates, is likely to care little about this temporary blip, but the average investor in the street, unaware of Mr. Market's tendencies, is likely to press the panic button if the value of their investments suddenly drops by double-digit margins. Woodford, well versed as he is no doubt about Mr. Market, I feel did not fully appreciate the fact that the rest of the investment universe do not think like us. The average investor has no appetite or tolerance whatsoever for collapsing net worths. The second issue experienced by the fund was that it had a large exposure to illiquid AIM market-listed stocks. The AIM market in the UK lists small, typically start-up ventures. There are plenty of quite attractive businesses operating on this exchange, but the problem you find in investing in AIM stocks is that pricing can be quite volatile. Daily double-digit rises and falls are the norm, and due to the tiny amount of stocks in circulation, liquidity can be poor. If an AIM business has a market capitalisation of only a few £1,000,000, it is easy to see why trying to sell even a relatively small amount of shares is going to be difficult without collapsing the share price. AIM stocks can be lucrative, but extracting yourself from these positions can be long-winded and patience-trying, and this also tied into the fund's travails. As investors demanded their money back, a lot of liquidity was tied up in the AIM market that could not be easily or quickly extracted. So how can we sum up the man who I still regard as the best British value investor of the modern era? Clearly what he did for over a quarter of a century at his Invesco Fund was no fluke, and he did not suddenly become a bad investor after starting his own fund. The issue was, I feel, he failed to fully appreciate that it is quite impossible to run a fund as an extension of how you would run some privately held portfolio. Whilst through conditioning and training you can have full control over your own emotions and remain resolute in times of market hysteria, you cannot expect the same from the hundreds of thousands of investors whose money you are managing. What makes a great private portfolio manager is far removed from one managing the money of others. At Invesco, he would have had a large team behind him, managing the sort of risks related to diversification and liquidity, leaving him to do the thing he did best. It would appear that at his own fund, this important matter was overlooked. It is quite understandable why those who lost a lot of money at his Woodford funds should be bitter about their experience, but it would be a great shame if he was only remembered for this dark period in his career. Because whilst it turned out his skills as a fund administrator were perhaps lacking, and his seeming lack of appreciation that not everyone can deal with the trauma of a concentrated portfolio of stocks, there is no question in my mind that there is nobody better in the business at the art of actually picking stocks. On that, we shall draw this episode to a close. I do hope that you've enjoyed it and the interesting case of Neil Woodford and his funds, has highlighted the very different skill sets required to manage some private portfolio that has the luxury of limited diversification and a fund charged with managing the money of the great body of investors. If you have enjoyed it, please do consider adding to playlist so that you can be alerted as soon as any new additions land. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.